However, in terms of whether or not these loans are anything to be concerned about, Moody's just went on record to say that the banking system and private credit markets are sound, and that one cockroach does not a trend make. That's a typo, by the way. I'm sure they meant to say doesn't make a trend. Anyway, in terms of banking failures, they also said that default rates on high-yield debt this year has been relatively low, holding under 5%, and are expected to drift down below 3% in 2026. By comparison, during the 2008 financial crisis, defaults on high-yield debt were in the low double digits. Although even with all of that said, it seems as though Congress is at least aware of the issues brewing beneath the surface, although instead of actually fixing the core problems here, they've decided to issue a new proposal that would raise the FDIC limits from $250,000 all the way to $10 million as a way to protect customers. So in terms of what I think, personally, it seems like this is a slight overreaction. And in terms of the stock market, it just seems like a lot of investors are very worried about overvaluations in the market and are really looking for any reason to begin selling off, especially as this occurs during a time where we have a government shutdown, issues with China, and gold prices are skyrocketing. But in terms of the banking crisis, look, I just never think it's a good idea to keep more than the FDIC insured limits of usually $250,000 at any bank at any given time, especially if it's a smaller bank. These are just good habits to practice, and even though the situation is probably a bit overblown, it seems contained, and it seems as though a lot of them have the liquidity to backstop losses, unless there is a major catastrophe, we're probably fine.